Hi, thanks so much for tuning in. This is BQ Prime. My name is Alex Matthew, and today we're going to be focusing on bond yields. If you've been looking at those bond yields over the course of February, you will have noticed that they've moved up, particularly on the 10-year yesterday. And over the last few days, you've seen a marked uptick in the yields. We're going to try and understand why that is and what the implications of that are. Mahendra Kumar Jajoo, the CIO fixed income at Mirai Asset, is joining me. Thank you so much, Mahendra, for taking the time. The first and the most obvious question is why are bond yields rising now when they didn't move very dramatically when the last rate action of the RBI took place?
So we have got some very key economic data over the last couple of weeks, which suggests that the inflation is not going down as fast as the people were expecting in the global context. So we have seen the inflation spike a little bit again in the US, and which is against the market expectation of a more, intense decline in the inflationary pressure. And then in the case of India, there has been a sharp increase in inflation. So just to give you the numbers, the inflation shot up in the month of January from about 5.7% in December to almost 6.5% in January. So that is, I think, what changed people's perception about where the interest rates are heading. And then we had a follow-up to the FOMC meeting and the RBI MPC meeting in early part of January by way of the minutes of the meetings, which are typically released 2 weeks from the date of the meeting. And then in both these cases, the underlying message from the members was far more hawkish than the market was hoping for. And there is no indication from any of the central banks that matter to us, which is the Fed and the RBI, that we are anywhere close to a pause. And I think that's what is tilting the sentiments back towards a little bit higher yields in the immediate context.
Okay, a couple of things here. Let's focus first on inflation, though. And I want to understand, as a participant of the bond market, whether this is the overarching thinking. The latest update in terms of the question mark of El Nino and the impact on monsoons, and therefore a possible implication for food stock and the follow on effect on inflation. So, that being the driver of inflation for the rest of this financial year. And that is why you're expecting that monetary policy is going to be hawkish. It's going to be focused on bringing down inflation. And so yields will be elevated. Is that the thinking?
So let's break it down into three parts. First is that there is an expectation that was there for the last couple of months that inflation will come below the RBI's upper band of 6%. And we saw it happen for a couple of months. Then the RBI's projection for the current quarter for the inflation is somewhere around 5.5%, and for the next quarter is somewhere close to 5%. Now we suddenly have out of nowhere inflation at 6.5% for the month of January. So that upsets all the expectations. And within that, the core inflation continues to be well above 6%. So that does not leave any elbow room for the Reserve Bank to cut rates in the immediate term, and then maybe possibly open up room for one more rate hike because of the global environment, where again the inflation has not fallen as sharply as the market was anticipating, and therefore Fed has given a guidance for rate hikes for longer and higher than market was anticipating. So there's a little bit of buy-in of that now. So there are two things that have happened in the domestic context. One, inflation was expected to remain low; it has gone up. The global environment, where the Fed might be hiking more than the market expectation. So just to give you the context, the market expectation of the terminal Fed rate has gone up by 85 basis points from about 435 to about 520 just in the matter of last 1 month. That, I think, constrains the Reserve Bank's maneuverability in terms of getting into a pause. So that is the first part. Now the second part that you were talking about, the anticipation on where the inflation might be heading, and then we are hearing about all this El Nino and kind of statistical predictions that we have at 4 normal monsoons. We never had 5 in a row, so this year could be a deficient monsoon. We have had a huge volatility in the cereals and the food item prices in the last couple of years since COVID. So we are sitting at a situation where the vegetable prices have corrected, the pulses have corrected for a long time now. So maybe there is a seasonal revival. So therefore, the second part, that the expectation for the inflation are again firming up because of the seasonal factors. And then the third part is that global bond yields are going up, so domestic bond yields are going up. But let's again put that into context. The 10-year yield hit high of 7.6 around that sometimes in August, September of 2022. Right now we are at 745. So after the bond yields hit 760, the environment improved because the Russia's-Ukraine situation kind of went into a stalemate. The COVID situation began to improve, and therefore the disruptions were kind of beginning to get out of the system. So 10-year yield went down to 7.15, and then it continued to trade between 7.15 to 7.25, 7.3 for a long time. It has now broken that range. So in that context, it has gone up, but it is still below the high that it had already hit in July. So if you put these three things in context, you will expect that 10-year might hit the 7.6%, which is its current cycle high again in the next 4 months. But that is still not is an alarmingly new development, sort of.
There is one theory that is doing the rounds and that you have not mentioned, which is the currency. And the fact that the RBI seems to be not explicitly, but seemingly defending a certain level. They say very clearly that they have defended volatility or prevented volatility in the currency market. But even you saw today and yesterday, you've seen that the rupee has appreciated and it is staying above that 83 mark. Is intervention causing moves in the yields in the short term? Can you look at it that way?
No, you're right that that could be a factor, and currency obviously is an important indicator. But from my perspective, I look at more into the cause and effect relationship. So to my mind, the currency is the effect of the various factors. So if you put together three things, that the globally the central banks are withdrawing liquidity. So even if they stop hiking rates, they'll continue to withdraw liquidity. That will continue to put pressure. A trade deficit has been of a very high order. Last month we had a little bit of reprieve, but if you look at the broader trend, the trade deficit continues to widen at a time when the FPI money is slowing down. We have had next to nothing of the FPI flows on a cumulative basis from a history where we every year used to have a decent amount of the FPI flows. You see the dollar index has appreciated from actually corrected from 115 level to about 105. It went to as low as 100 point something also, but rupee has stuck in that 82, 83 band. So therefore, there is a pressure on the currency, which is possibly a driver in the immediate context. But I think if you look at the cause and effect, then the earlier factors that we discussed are more relevant. So rupee is one of the collateral damage in the whole macro environment. But you are right that in the immediate let's say 1 week, if you look at it, maybe there is some impact of the RBI withdrawing liquidity, putting pressure on the money market. Then we need to also look at one very adverse development from the money market point of view, that for the month of March, the government has increased the issuance amount of the treasury bills by about 50,000 crores and across the 91, 182 day and 1 year category. So there is theoretically, therefore, that much additional pressure on the money market rates on that count. So it's a combination of the factors in my view.